I'm Edward Shelswell White, and this is the signal report for December 2025. And you can see we are in the holiday spirit here. That's it. So the signal for the U.S. economy appears to be that it's coasting, or as we've said here, sort of taking a wait and see approach. Although Q3 GDP was up sharply, inflation remains sticky at 2.7%, which is again well above the Fed's 2% target rate. Recent Fed reductions may help with GDP, but are unlikely to help the Fed hit the target inflation rate, all other things being equal. Now, rate cuts appear to be over for now, so we'll have to wait and see what happens both with GDP and with inflation. But there are some consumer indicators that we're worried about that we'll point to in a second. Because those consumer indicators remain bearish. The unemployment rate ticked up significantly year over year by almost a half a percentage point, and white collar jobs appear to be disproportionately at risk because of the advent of AI. We'll talk more about that in a minute. Meanwhile, consumer sentiment, we alluded to a minute ago, this is how consumers feel about the current state of the economy as reported on a monthly basis by the University of Michigan. And consumer sentiment remains at or near historic lows, both on a monthly basis and a 3-month moving average basis. So consumers are not feeling very good about the state of the economy right now. How are they feeling moving forward? Well, that's consumer expectations. And while those are improving slightly over the last few months, consumer expectations, as measured and reported by the University of Michigan, remain again near historic lows. Again, sort of a bearish sign for the economy. And more so when you think about moving forward, inflationary expectations remain extremely elevated still today, although down from their peak of about nearly a year ago, earlier on this year. They're still higher than they have been at pretty much almost any time since we've been tracking these for the last 10 years, and nearly as elevated as they were during the inflation heyday of early 2022 when inflation was at 9 to 10%. So 3 to 4 times what it is today. And inflation expectations among consumers tend to a degree to be self-fulfilling. If I think things are going to be more expensive tomorrow, I'm more likely to buy them today when my dollar is worth more, and that drives up in the short term prices. So we'll have to kind of keep an eye on these trends to see how it bears out, but they're not healthy indicators and are very concerning for us from a standpoint of consumer willingness to spend. Moreover, when you look at what employment is happening, we've already talked about how unemployment is up year over year pretty significantly. But according to a Wall Street Journal article out this morning, in fact, companies, when they're thinking about 2026, they're planning investment in things more than in people, in equipment more than in staffing. And this has a negative effect on employment in two ways. First of all, fewer jobs are created. Well, obviously, that's kind of a duh. Obviously, that's the case. But second, because fewer jobs are created, people who are currently employed are more likely to stay in their current jobs and not be looking for or even open to a transition to a new job. And together, these two factors have the employment equivalent of taking liquidity out of the market. This is an unhealthy sign for the U.S. economy, but it won't be evenly distributed because among people in the airline target traveler demographic, white collar jobs are more likely to be affected currently anyway than blue collar or trade jobs, which, by the way, you might have noticed often pay what used to be considered white collar salaries these days. In any event, if this effect is disproportionately focused on white collar jobs, it will also likely have a deleterious effect on air travel because those white collar jobs account for a disproportionate percentage of profitable flying that airlines do. If they dial back their travel plans, then airlines and their airports will feel the pain. And in fact, we're seeing signs of this already in our actionable location intelligence data. Turning to the signal for the industry, basically what we're saying is airports either need to produce stronger margins for the airlines or they're going to be the ones who are at risk for losing capacity. Currently, airlines are continuing to be incentivized to shrink relative to GDP. As you can see here, year over year, airline revenue versus GDP shrank 2.5%, 2.6%. This is continuing a trend that started back in the first Clinton administration. And even though things like operating revenues went up, operating costs went up more, and therefore operating margin dropped. Even though, and then you're seeing things like RASM dropping and CASM dropped, or RASM dropped more, having an effect on operating margins. So every piece of good news is offset by a piece of slightly worse bad news, and so that's squeezing airline margins. And next year, the squeeze is likely to continue. In 2026, real GDP adjusted domestic departure change will be flat-ish. Expected GDP growth next year is 1.7%. The FAA forecast a 2.6% increase in ASM growth, but 2% of that is or only 2% seat change on a 2.6% ASM growth because about a 0.3% increase in stage length and a 0.4% increase in gauge means that basically our relative to GDP, our capacity is basically flat. And this will pressure unit costs. Input costs are rising by and large, although there's a nice good guy here in jet fuel dropping year over year. But unit costs are rising and capacity is flat. That means that carriers have to either find a way to make better margin from their existing capacity or cut capacity to match the demand that's profitable. So that's why we expect carriers to push for higher margins in 2026. And if your airport can't produce them, either by driving higher load factors or attracting more profitable customers, unless you're uber strategic for one or more carriers, your capacity is at risk. And ultimately, this is not just a pressure that's internal to airlines. Other than United, Allegiant, and Southwest, airlines are not keeping pace in terms of stock price with the S&P 500, and with the majority of all airline stock owned by a relatively small number of large institutional investors, you can bet that two messages are delivered on a routine, if not daily, basis to and within the airlines. One, the investors are pestering airline CEOs to produce better returns with an explicit or implied or else. And two, those CEOs then tell their network planning leaders, your network design isn't making enough money. What are you going to do about it? Until that changes and until airlines are producing returns at least equal to, if not better than the S&P 500, because remember, what investors care about is risk-adjusted return. And as you may have noticed, the airline industry is a risky investment. So the return on an airline stock really needs to be better than the S&P 500 to justify investment relative to the risk. Until that happens, well, this is why we maintain that airlines will continue to have a bias to shrinking and why airports' ASD and marketing efforts should be focused more on improving the performance of existing service than on attracting new service. If your existing portfolio is producing substandard returns or less than what the airline needs, asking them for new capacity is sort of a waste of time. The focus needs to be on making the capacity you have currently work better. And only then, unless you're uber strategic for one or more carriers who are looking to invest and wait for some longer term return, airlines are looking for the return right now. And the best way to maintain and grow capacity is to make sure the capacity you already have is performing at or above airline expectations. And that's it for the signal report for December 2025. Tune in late January, where we will have the next version of the signal report for January with December data, where we help you find the signal in the noise.